Picture this: you open your brokerage app on a Tuesday morning, coffee in hand, completely normal day, and then you see it. Red, everything is red. Your Nvidia position down 8%, your Microsoft down 6%, your whole tech portfolio looking like it got hit by a truck overnight, and you're just standing there in your kitchen, coffee going cold, thinking, what did I miss? What is happening right now? Here's what happened. The Nasdaq just dropped over 10% in a matter of weeks. And if you've been watching the news, you already know why: geopolitical tension, conflict escalating in the Middle East, uncertainty around oil, and suddenly every institutional fund manager on Wall Street decided to hit the sell button at the exact same time. And retail investors, regular people like you and me, we panic right alongside them. We either sell everything and lock in our losses, or we freeze up and do nothing while the opportunity of the year quietly walks past us. But here's the thing nobody is telling you. This is not a crisis. This is a sale. And the people who understand what's actually happening right now are the ones who are going to look back at March 2026 and say, that was the moment everything changed for me financially. So let's slow this down. Let's actually understand why tech stocks specifically take the hardest hit during geopolitical conflict, why this pattern has repeated itself over and over throughout market history, and most importantly, what the smart money is actually doing while everyone else is panicking. Because the Nasdaq dropping 10% is painful if you don't understand it, but if you do understand it, it's a gift. Let's start with something that confused a lot of people. Why tech? Why not energy stocks or defense contractors or banks? When there's a war escalation, when missiles are flying and oil prices are spiking, why is it that the companies making AI chips and cloud software are the ones crashing the hardest? That doesn't intuitively make sense. Netflix isn't manufacturing weapons. Nvidia isn't an oil company, so why are they down double digits? The answer has everything to do with something called the risk premium, and once you understand this concept, you will never be confused by a tech sell-off again. Here's the mental model. Imagine you're deciding between two investments. Option 1, a bakery in your neighborhood that makes steady, reliable profit every single year. Option 2, a tech startup that's losing money right now but has the potential to be worth 50 times more in 5 years. In normal times, you might choose option 2 because the future feels safe, the economy feels stable, and you're willing to wait for that big payoff. But the second uncertainty enters the picture: war, inflation fears, a banking scare. You stop thinking about 5 years from now, and you start thinking about right now. You pull money out of the risky bet and put it into the safe bet. You rotate out of growth and into safety. That's exactly what institutions do during geopolitical shocks. And high-growth tech stocks, your Nvidias, your Microsofts, your Metas, they are the ultimate long-duration assets. That's the Wall Street term for it. Long duration means the company's value is heavily weighted toward future earnings, not current earnings. And when conflict breaks out and the future feels uncertain, future earnings get discounted aggressively. Investors basically say, I'm not sure that future is going to look the way I thought it would, and so they sell. Meanwhile, energy stocks go up because oil prices spike. Defense contractors go up because governments start spending more on weapons. Consumer staples stay relatively flat because people still need toothpaste and food regardless of what's happening geopolitically. But tech bleeds, every single time. Look at the historical data. When Russia invaded Ukraine in February 2022, the Nasdaq fell nearly 20% over the following weeks. When the Gulf War broke out in 1990, the S&P 500 fell around 17%. After 9/11 in 2001, the Nasdaq fell over 30%. And what happened after each one of those drops? The market recovered. Not eventually, not years later, within months. The S&P 500 fully recovered from the Ukraine invasion sell-off in under a year. The market recovered from the Gulf War shock in roughly 6 months. This is not speculation. This is the documented pattern. Geopolitical conflict creates fear. Fear creates selling. Selling creates discounts. And discounts, if you have the stomach to buy into them, create generational wealth-building opportunities. Now here's where it gets really interesting for right now, in 2026. The conflict that triggered this particular correction is different from past geopolitical shocks in one specific way, and that difference actually makes the opportunity better, not worse. What we're dealing with right now is a regional escalation that has significant psychological impact on markets, but limited direct economic impact on the companies being sold off. Companies like Nvidia, Microsoft, Alphabet, Meta, their revenues are not tied to the stability of the region where the conflict is happening. Their customers are global businesses, cloud computing clients, data centers, advertising platforms. The war isn't shutting those customers down. In Wall Street terms, this is called an indiscriminate sell-off. When fear takes over, people don't sell carefully. They don't sit there analyzing which companies are actually exposed to the conflict and which ones aren't. They hit sell on everything with a high valuation and a tech label, and that creates what sophisticated investors call a disconnect between price and value. The price of Nvidia went down. The value of Nvidia, meaning its actual business, its revenue, its AI chip dominance, its forward order book, did not change. The business is the same business it was before the correction. The stock is just cheaper now. That gap between price and value, that's the opportunity. Warren Buffett has a quote that gets repeated so often it almost loses its meaning, but let me give you the actual context for it right now. He said, "Be fearful when others are greedy, and greedy when others are fearful." He wasn't being poetic. He was describing a literal market mechanism. When everyone is panicking and selling indiscriminately, assets get mispriced, and mispriced assets are how long-term investors make serious money. Buffett's firm, Berkshire Hathaway, deployed billions of dollars during the 2020 COVID crash, not in spite of the fear, because of it. So let's talk about what this correction actually looks like in real numbers, because the math here is important. Going into 2026, Nvidia was trading at a price-to-earnings ratio of roughly 35. After the Nasdaq dropped 10%, that same stock, same business, same revenue trajectory, is now trading at a materially lower multiple. You're effectively buying the same company at what were 2025 prices. For a company that posted revenue growth of over 80% year-over-year in its most recent earnings report, a 10% price discount is not a small deal. Compounded over 5 to 10 years, entry price matters enormously. Here's the math that should wake you up. If you buy a stock at a 10% discount today and it grows at 15% annually over the next 10 years, that 10% discount doesn't just save you 10%. Because of compounding, your lower entry price amplifies every single year of growth. A 10% better entry price on an investment that compounds at 15% annually over 10 years results in an ending value that's roughly 27% higher than if you'd bought at the pre-correction price. The entry point matters more than most people realize. This is why professional investors love volatility, not because they enjoy the red days, but because volatility is the mechanism that creates mispricings, and mispricings are how you generate alpha, which is just the finance word for returns that beat the market. Now I want to address the thing that's going through your head right now, because I know what you're thinking. You're thinking, yeah, but what if it keeps dropping? What if this isn't the bottom? What if the conflict escalates further and the Nasdaq falls another 10%? That's a completely fair concern, and here's the honest answer: nobody knows. No analyst, no fund manager, no algorithm can tell you with certainty where the bottom is. Not one. Anyone claiming otherwise is lying to you. But here's what the data does tell us. Trying to time the exact bottom of a market correction is one of the most statistically documented ways to underperform over the long run. JP Morgan published a study showing that if you missed just the 10 best trading days in the S&P 500 between 2003 and 2022, 10 days out of nearly 5,000, your annual return dropped from 10% to just 5%. Missing the 20 best days dropped your return to around 2%. The best days in the market almost always happen during or immediately after periods of maximum fear, which means if you're sitting on the sidelines waiting for the market to calm down before you buy, you are almost guaranteed to miss the best recovery days. The strategy that actually works, backed by decades of data, is dollar cost averaging into the dip. You don't try to call the bottom. You don't put everything in at once. You spread your buying across time. Maybe you buy a third of your intended position today, another third if it drops another 5%, and the final third either at another dip or when you see confirmation of stabilization. That way, you're never all in at the worst moment, but you're also not sitting on the sidelines missing the recovery. And the companies worth looking at during this particular dip are not mysterious. They're the obvious ones, the ones that were already dominant before the correction and are now simply cheaper. Nvidia, which controls over 80% of the AI training chip market and has a forward order book that suggests continued revenue dominance through at least 2027. Microsoft, which has integrated AI across its entire product ecosystem and reported cloud revenue growth of over 20% year-over-year in its most recent quarter. Alphabet, sitting on over $100 billion in cash reserves while growing its AI-driven advertising business and its Google Cloud segment simultaneously. Meta, which rebuilt itself from the ground up after the 2022 collapse and is now generating over $60 billion in annual free cash flow while deploying some of the most advanced AI personalization systems in the world. These are not speculative bets. These are the infrastructure of the global digital economy, and right now they are on sale. There's a concept in investing called a quality correction, and what we're experiencing right now is a textbook example. A quality correction happens when market-wide fear causes high-quality companies to drop in price even though nothing about the fundamental business has changed. It's temporary. It's driven by sentiment, not fundamentals, and it creates the single best opportunity for long-term investors who have the knowledge and the emotional discipline to act while others are reacting. I want to tell you about what happened to an investor named David, not a hedge fund manager, just a regular guy who lived through the 2020 COVID crash. When the S&P 500 dropped 34% in March 2020, David did something that felt insane at the time. While everyone around him was predicting economic collapse, he started buying Apple, Amazon, Microsoft. He didn't go all in on day one. He spread his purchases across 3 weeks. By the time the market recovered, which took less than 6 months, his portfolio wasn't just back to where it started. Because he had bought additional shares at depressed prices, he was sitting on gains significantly beyond his pre-crash position. The crash didn't set him back. The crash accelerated his wealth building by years. The math worked because the companies he bought were real businesses with real revenue and real competitive advantages. They weren't going to zero. They were temporarily mispriced, and that's the same situation sitting in front of you right now. Here's the thing about understanding market history that changes how you emotionally experience corrections. Once you've seen the pattern enough times, geopolitical shock, indiscriminate sell-off, temporary pricing disconnect, recovery, new highs, you stop feeling the fear and you start feeling something else. You start feeling the quiet excitement of someone who just walked into a store and found exactly what they wanted at 30% off. The average investor's biggest enemy isn't the market. The Nasdaq has returned an average of roughly 13% annually over the past 30 years, through wars, recessions, financial crises, pandemics, all of it. The biggest enemy is the emotional response to short-term volatility. The urge to sell when things feel dangerous and buy when things feel safe, which is the exact opposite of what builds wealth. Selling at the bottom and buying at the top is the guaranteed formula for financial underperformance, and it's what the majority of retail investors do consistently, decade after decade. You don't have to be in that majority. The 2026 correction has a name already. Financial media is calling it the war correction, and 10 years from now, it will have another name too, the buying opportunity that the nervous crowd missed and the prepared investor seized. History has given this correction a name twice before under different circumstances. In 2009, people who bought during the financial crisis made 10 times their money over the next decade. In 2020, people who bought during the COVID crash doubled their money within 18 months. The script is the same every time, only the headline changes. So here's what I want you to actually do, not think about doing. Actually do. Open your brokerage account this week. Look at the companies in your watch list, the ones you've been saying you'd buy when they go on sale. They're on sale. Make a plan. Decide how much you're willing to invest, split it into 2 or 3 tranches, and start executing. You don't need to be perfect. You need to be in the game. Because the people who build real wealth through investing are not the ones who found some secret strategy. They're the ones who understood the basic principles well enough to act when everyone else was too scared to. They're the ones who looked at a red screen and saw a green opportunity. They're the ones who didn't let the noise on television override the signal in the data. The Nasdaq just dropped 10%. The AI revolution didn't. The cloud computing build-out didn't. The digitization of the global economy didn't. The fundamental story behind every major tech company you've been watching, that story didn't change because of geopolitical conflict half a world away. The price changed. And price is the only thing you can actually control when you buy. This is your moment, not because I'm telling you it is, but because the historical data, the business fundamentals, and the behavioral patterns of every previous market correction are all pointing in the same direction. The fire sale is open. The question is whether you're going to walk through the door.